All right, now that we are here, let's get started. Good job on your pitches. They're really good. I guess to see some of the hilarious pitches I put together my freshman year, that I had the pleasure of sharing with Phil. Let's see. So this is the one I put together my freshman fall. It was real bad. It's comically bad.
Oh my god.
So y'all should feel very proud of yourself for your work. Like these are my slides. They were really bad. We just took the photos.
I would do that. That was in my 7th grade presentation.
You and a group of other people in the club.
Yep.
This?
Oh, DCF. You made a DCF.
We made a DCF. So as you can see, the pitches this year much improved. And it's not like we had like chumps. Because like we have like other than that group, there's me, then we have our old president, who's currently at Goldman. We have 2 people at JP, and another guy was like the president of the Cornell Accounting Association at that time. So it's not like we had like that people. Every pitch just looked like that. So therefore, y'all should feel very proud of the things you put together because they look really good.
Yeah, who did that with the new like format? Because like now they're good, so like clearly I have to start somewhere. So when was the shift to like this slides?
Template, like everything I
So this template was done I think a couple years ago. It's like 2, and then I kind of remade it and made it the thinner one versus the really long one. That's because that's what I used this summer, and I kind of like this. Also, low key, there's not that much content on each side, so I'm gonna make it seem like it feels more true. All right, cool. So basically, there's no need to play with Excel today, just because you have your hands full already with the DCF. So we're just going over leverage buyouts today because it's a thing people ask about them on interviews, and they are a commonly used investment strategy. So it's cool to understand what they are and how like firms do it. But like LBO models, you can wait until next year to learn how to do them, because there's a lot of like jargon in terms of debt, as well as basically applying everything you learn onto the model itself. So I'll walk you through what I did in IB Essentials, but other than that, like don't worry about actually doing one, or like excelling one out. Great. So basically, a quick summary of what they are. So these are just 6 bullets here, but essentially, the idea of an LBO is you will take on a lot of debt. You will also put up some of your own money, and then you will go and buy some random company that makes sense, and we'll go over what makes sense later on. And then you will use the company's profits or like cash flows to pay that, or like so, like I guess measure profit. So you'll use the cash flow generated by the company to pay down the debt, and then after a certain amount of time, you'll sell off that company. Now that it doesn't have a lot of debt on its balance sheet because you paid it off with the firm's cash flows. When you sell it, you will earn the difference in terms of the equity, and that's how you make money. So if that was confusing, we're gonna illustrate it through buying a house. So I actually lived in this house for 10 years, but that was a pretty good example actually, so I just used it. So this is from Zillow. You can see that we bought this house for $1 million in 2008, and then we sold it for $1.9 million in 2017. So around a 10-year investment. So essentially, as you all know, when buying a house, you have a down payment, and then you take out a mortgage. So the mortgage is when the PE firm takes out the debt, and then they put up the down payment, so their equity. So basically, typically in a house, it's a 20% down payment, and they take out on 80% debt. So therefore, we put up $200,000 for a down payment and took out $800,000 of debt. And then we will assume, even though we live in it, for this exercise, we will assume we rent it out. Therefore, we can make $40,000 a year through renting it. So aka we will make, in 10 years, $400,000 worth of rent, which we will use to pay down our debt. So there are several different scenarios where we can make money. So you can see on the left side, there's a debt pay down scenario. Basically, we took that $400,000 of rent money and paid down our debt with it, and that left us with $600 of equity and $400 of debt. because we started off with a total pie of $1 million. Since we paid down 800 of that debt, the debt is now 400. So therefore, of the remaining pie, we now own 600 million of it. So you can see that had we sold this house for $1 million, we would have gotten back $600, and we put in $200. So that is not too bad over 10 years. Then the other scenario is we can grow the value of the house. So imagine if we paid down none of the debt and we just grew the company, or in this case, the house. The house raised, so basically it went up in price, and we eventually sold it off for $1.9 million. As you can see, now we have 1,100 in equity, and we started off with 200 in equity. Therefore, we earn like 5 times what we put in. And then typically, like under the best case scenario, you can have both. So here, like we paid down $400 in debt, $400,000 in debt, and the house rose to 1.9 million. So we earned 900 million from like the increase in the house is worth. So through that, we now have 1,500 in equity and 400 in debt. So you can see here that there's a potential range for very, very strong returns, because you're essentially because the power of an LBO is you take on so much of the debt to begin with that you put in very little of your own money. So then once you pay down that debt, and then any growth from the company is just sugar on top, you can earn like a very, very good investment return on your investment, which is why like PE firms are super attractive for people to work for, as well as an investment vehicle. And you can also see here the difference between debt and equity. So debt, no matter how much the thing grew, stayed at like 800, and then you paid it down to 400. So when the house grew, all of that went to equity. So you can see here that the equity there's upside to equity, but for debt, the debt holders, the bank that gave us the mortgage, got none of this upside. So you can see again the difference between equity and debt. Right. So this is just a basic version of how LBO works. But obviously with debt, there's also risks. So going back to the other slide, this is not a trick question, but do any of you see a major problem here? Think about historical events that happened. Correct, yes. So before the price went up to 1.9 million, we bought it in March 11, 2008. As you all know, the market bottomed out in like early 2009. So basically the crash happened right as soon as we bought the house. So essentially our house within the first year went down in value by 200,000. And then therefore our debt still stays a debt, so we still owe the bank. So essentially my family had $0 in equity in our house, and we still owe $800 of debt on it, because the bank now own all of our house, or the 100% of the worth of the house. So being the people we are, a lot of people during recession basically just gave their house away, and the banks got screwed. But my family stuck it out, and we paid down our debt. Again, my parents are engineers, not in finance, so they don't understand the value that and plus cultural things, they're going to pay down the debt. But anyways, it turned out fine in the end. But you can see that this is a risk to this sort of investment, because if your company is worth less than you thought it was when you entered it, you have potential to lose a lot of money. So while there are potential for high returns for a PE firm, typically between like 18 to like 25% year over year, there's also a huge potential for risks if things go wrong. So yeah, that was the story. So that's basically how LBO works. So instead of a house, you do it through real companies. You borrow a lot of money to take out debt to buy the company, pay down the debt with the company's cash flows, and then sell the company through a variety of means to earn your return on investment. Cool. Any questions about this so far? All right, cool. So first, actually, before you read that, what do you all think would make a good LBO candidate? Yeah. Yeah. Good. And any other ideas? Okay, yeah. So that is one. Like if a company has potential for growth, you obviously makes it more attractive. But typically in LBO, like high growth also trades off of stable cash flows because high growth companies tend to like be in like high growth sectors or like unpredictable phases of development cycle. But if you can have a company that you're sure will grow, then obviously that's a great investment. Yeah. But typically like LBO companies work with very, very mature companies, just because they emphasize the cash flow predictability. All right, cool. So, I mean, those aren't the main ones. So the main thing is stable cash flows. Like the number one is probably the most important. So basically, and again, so there's stable cash flows, but also you need to make sure it's also not cyclical. So for example, the semiconductor stocks you all pitched probably wouldn't make great LBO candidates because even though they might be established companies, the semiconductor industry is very cyclical in the sense that like demand rises and falls, versus like something like a consumer company or industrials company where they produce like a certain amount like every single year. But because basically like if you have cash something on a down cycle, it might really screw over your predictions and projections when you enter the position. So like it represents a high degree of risk. So if you want stable ones, but also one that are not cyclical. Great. So the second one has to do with the flip side of that. So the top one is about like generating cash. The second one is like low capital expenditure and working capital needs. And capital expenditure, again, is you spending money to invest in like capital assets, so your PP&E. And then working capital is like needing cash to actually run the business itself. So the reason why you want them to be low is having low cash needs means that more of your cash can be used to pay down your debt instead of being tied up in like reinvesting in the business or being tied up in operating the business. And the third one, similar, room for capital structure improvements. So for example, a lot of like firms or companies don't have enough debt. As you all know from debt, when you have debt, you pay interest expense, and that can be used as a tax shield against your like implied tax rate. So therefore, if there's room to take on more debt, then it'll make sense for you to like lever up or like take on debt to buy this company, because having a lot of debt on a balance sheet means when you pay interest expense, you pay less taxes. So then there's a lot of tax savings that can be realized to make your operations cheaper. And then second, there is deemed undervalued by the market. So again, like kind of like to Nick's point, a company with high growth. So like if you think this company is more valuable than people are giving it credit for, then it could be a good reason to enter and like take and like buy out this company. And then like once the market catches up to its real worth, once you sell it, you'll make a return through like the growth of the company. So in that case, like even if you don't pay down a lot of debt, as soon as it grows to a certain point, your equity will also increase to a point where you generate strong returns. And then strong management team. So this one's actually debatable. So on one hand, you do want a strong management team because like ideally you don't want to be spending the time like running the company. You want the management team to run the company. On the other hand, like a weaker management team means that you can have more room and more of a power to like make the cost cutting decisions versus like a strong management team might like resist like your efforts to like cut down on operations. And finally, room for operational improvements. So again, this includes cost cutting, business improvements to expand into like different product lines to make more cash. And also like if there's like a part of the company that's not doing so well, or you feel it's like not worth it keeping around, you can sell it off. And then you will generate that return immediately that can either be used to pay down the debt or just operate, like focus on other parts of the business. And then you have like a piece of the business that you think is more valuable that you exclusively. All right, cool. So next, this is like sources and uses of funds / capital structure. So this is probably the most complicated part of the LBO in terms of like understanding / or most jargon based. It's probably not the most complicated one, but it has a lot of jargon. So in terms of equity, the first one sponsors, this is just your PE firm. So like i.e. like Blackstone, Bain Capital, etc. So they're the ones that put up capital, the quote unquote down payment by the company. So that's the one you really have to know. The second one is called basically management rollover. So existing management can like own equity in the company, so they can offer to like stay on and be additional source of equity. So the PE firm doesn't need to pay as much. Obviously, the flip side is if you increase the value of the firm, since the management is also part of the PE firm and hold equity in it, because equity enjoys upside from growth, they take a cut of your equity that you get equal to the proportion of money they put in when you enter the position. And then the second part is debt. So this is like a bunch of very jargonish terms. I sent out a massive a document that explained what all these are. So it's not too important to know for now. So essentially, there are different levels of debt. Leveraged loans are typically A, given by the bank, and B, secured by a firm's assets. So essentially, like a mortgage is like a leveraged loan because you take a loan from the company, and then if you don't pay down a loan, the bank takes your house. So that loan is secured by the value of a house as collateral. So therefore, that is referred to as so these loans are secured by like the assets of the company. And basically a term loan A is just from a bank, and a term loan B, C, and D, etc. are syndicated to institutions. And what that means is different, like for example, hedge fund, mutual fund, etc. They can buy a piece of that debt, and then the interest payments and the payments you make on that debt will go to like each piece in proportion to what they own. So that is in a sense what like the term loan B, C, and D are. But like specifically, like that's like the bare bones you need to know. Beyond that, like it's not too necessary unless you specialize in like restructuring or specifically in like focusing on like raising debt for companies. Next is a revolver. So typically a revolver is attached to a leveraged loan in a sense, and basically like you can take out a loan. They also give you like a credit card essentially that allows you to take out money when you need it for the company's short-term working capital needs that you have to pay down first afterwards. But yeah, just treat this as a credit card for the business. And then high yield bonds. So this is when you start to become unsecured. So if the company goes bankrupt, they can like get their money back insofar as like they can pay back, but none of the firm's assets will be going to them because they only serve as collateral for the top two. So therefore, investors in this will expect a higher return or interest payment by the company to them in order to offer the debt to like buy the company. And finally, there's mezzanine debt, and this is basically just above your equity, and essentially, like basically, like the official definition of mezzanine debt actually includes everything under the most senior debt, but what it's used to refer to actually in practice is just things with both debt and equity characteristics. So, for example, a convertible debt that acts as debt, but the debt holder can like have the option to convert it into equity if things go well. So, therefore, that's mezzanine debt. And basically, if the company goes flop, they are the last to recuperate their money before the people on top of them. So again, this part is definitely the most jargon and complicated. Just know that they are part of the debt structure that the bank will use to buy the firm when they're entering a PE position, when they're entering doing a leveraged buyout. But other than that, like you will encounter these as you go and learn more about them. But for now, just a brief introduction. And then finally, when you buy a company, there's cash on the balance sheet you can use, and that's also a source of funds. And in terms of what you use it on, so first, most obvious, your equity purchase price. You have to buy the stock of the company from the people who hold it currently. Then there's refinancing existing debt. So when you buy a company, typically the debt they already have, it triggers like some like clauses in most contracts that you have to refinance it, aka pay it down now, and then take on new debt. And this gets into a lot of legal jargon. So it's just basically like paying, like there's a clause in a contract that means you must refinance that debt to take on new debt to like replace it. And the minimum cash balance because a business needs cash to run its company. Then there's transaction fees. So you pay your investment bank who help you do this transactions their fee, and financing fees. So you pay like money to like take out loans. So there's like costs associated with that, so you pay that. The last three are not as important. So essentially, the bulk of it is equity purchase price and to refinance existing debt. All right, great. So you can see here that the LBO share of total mergers and acquisitions is very low. It typically hovers like 20% of deal value and like 10 to 15% of like deal count. And the reason this is because people much prefer selling themselves to like other like companies. So for example, like if I were a tech startup that has recently become mature, I would much rather sell myself to like Apple or something versus a private equity firm, because the goal of a private equity firm is to make a lot of money. So they want to try to buy you for as low as the price as possible, versus like Apple, like they see value in combining their business with your business or your business to their business. So there's like synergies they can realize. So they are much more willing to pay a higher price for your company than like a private equity firm will be. So therefore, you typically see like private equity is a lower share of total merger and acquisition deals. Obviously, people like tend to take the best offer possible, so sometimes the PE firm wins out. And here you can see that average EBITDA purchase price multiple for US LBOs. So typically we measure how much debt you take out in terms of EBITDA. So again, EBITDA is earnings before interest, taxes, depreciation, amortization. So you take out D&A because it's non-cash, and then before interest and taxes, and that is essentially how much you have to pay down the interest that you owe to these loans. So typically you can see that firms you've seen a steady rise from 7 to like 10 over the last like 20 years about the value of the firm when you enter the LBO, and the people have been getting concerned that this is too high because you need to resell this company at this times multiple in order to maximize the returns. So if you buy it for too high of a multiple, then you take a lot more risk trying to sell it for the same multiple. So this is like an area of major concern to people and like might affect the LBO markets going forward. And you can see here that typically so first lien is essentially the most senior debt. So if a company goes bust and goes bankrupt, they're the people who recuperate their losses first before anyone else. So junior debt is right below them. So they are after these people in terms of getting their money back. And then finally, equity people are paid down last. So you can see that equity before was a bit smaller. Now they typically make up like 35 to 40% of the purchase price of the firm when you're buying a company for an LBO. The first lien debt is around like 45 to like 55%, and then the junior debt is a bit less. Because again, people are less willing to take off junior debt because it's much more risky, since they get paid down after the senior debt. Right, and then there's several different exit strategies. So first is the IPO. This stands for initial public offering. So essentially, you sell your shares to the public in a public offering, and then you have your strategic acquisitions. So you're selling your company to a strategic acquirer. So this is again like when I brought up the example of like selling your recently matured tech company to Apple, because other strategic companies, which strategic just means other corporations, so not financial firms, but corporations that like produce like real like value in the economy. So these people are willing to pay for a synergy, because the idea of combining two businesses together means that your business gets stronger like as a whole more than sum its parts. So they're willing to pay more for your like company that you're trying to exit than like some other people. So this is actually the preferred way to exit. And then finally, there's sponsor to sponsor. So you're selling a company to another PE firm. So those are the three ways to exit. The last one is called a dividend recap. So this is not really exiting your position, but a sense that once you pay down a sufficient amount of your debt, you essentially retake out a lot of debt, and then you pay yourself a dividend using the money from that debt, and then you like in the future you pay down that debt again through your company's cash flows. So essentially you can think of this just doing the same thing over again. You said you're taking a return by taking on more debt and paying yourself debt. So obviously you might ask, why would banks like agree to do that? Because you're essentially lending money to a firm, and then the firm doesn't use anything to like help its own operations. The other thing is like banks make money from like loans, so like they make interest off of those loans, and if they don't like firms doing it, then like private equity people just won't take out debt from that bank, so the banks will lose market share. So the banks are kind of put in an awkward spot in terms of like not liking this, but being forced to do it because it's part of normal operations. And you can see here exits by type. As you can see here, strategic, aka selling it to another company, way higher. Because they're willing to pay a synergy, pay a premium for synergies realized. They have sponsor to sponsor and then IPO. So IPO is the least because it's very hard to do. It's a long process. And also like these people are just buying shares at face value. So there's no like premium that like anyone's up here willing to pay because only strategic people can realize synergies. And regarding sponsor to sponsor, so because like they're trying to make as money as possible, so it's hard for them to outcompete these people. Private equity companies have actually been like kind of building platforms. So aka they're gonna buy a bunch of different companies that fit together. They're gonna make like a bigger company that realizes the synergies between each of the smaller companies they buy. And that way they can like increase their returns because once two companies can work together through one like private equity sponsor, then that means they can also realize some synergies that before only strategic acquirers can do. All right, so that is the LBO. Any questions? Or has it been pretty clear so far? So like this is more complicated than a DCF. So we're just going over this now so you all know what it is. But don't expect to do this until like you get on the job or you take a class that goes way more in depth onto this. All right, cool. So that's it for the presentation. So just to show you all a LBO model we did in class, this is obviously not a very complicated one, nor is it like something you'll see in industry because it's just a bare bones thing to illustrate the point. But essentially, you can see here that the first thing you want to do is to focus on the entry. So here we are having a current share price of $158.96. And I believe this is for Lear Corporation, which is like some car part maker. So again, like an industrials company, cars are constantly being produced. So reasonably stable cash flow. So we decided to analyze this company. So to buy out every one of the public shareholders or shareholders, because this company is public, you have to buy out a bunch of different shareholders. So to give them a reason to sell their shares, you have to pay a control premium. So that's 25%. So we assume the acquisition price to be $198.70 per share. You multiply that by fully diluted shares outstanding, so we get an equity value of $13 billion. And then you have your net debt. So your enterprise value is your equity value plus net debt plus your other items. So this is your other items to get an implied enterprise value of $14 billion. So essentially this is saying we need to come up with $14 billion in order to pay for this company. And you can see here are some other things. So there's $77 in transaction cost and in financing fees to take out the loans. The tax rate 21%, and we need a minimum cash balance of $100 on the balance sheet. So you can see here that uses of funds. You have your 13,651 equity value plus your 460 in net debt. So that's your enterprise value to buy the company, and then plus your various fees. So in total, we need $14 billion in order to make this transaction happen. So on this side, you can see that total sources is 14. So therefore we need total sources to equal $14.5 billion. You can see here that the percentage of the capital structure, the term loan is 49%. So this is their top most senior debt. Then they have a subordinated debt of 16%. And then we're going to put up 34% in equity. So that gets you to $14.5 billion. So therefore, our sources equal our uses and thus we can make the transaction happen. Does this part make sense? Cool. So then you have your various assumptions. So basically, this is like a very bare bones income statement. We expect to generate net income of this amount, and here so this is the income statement. We expect to generate this amount, and then we have a cash flow statement. So we basically adjust net income back up to free cash flow. So this free cash flow is the amount we have available to both pay our interest expense as well as so this free cash flow is what we have left. So I accounted for interest expense up here. So this free cash flow is what we have remaining to be able to pay down our debt. Great. These are just some of the assumptions. So therefore here you can see that this is called the waterfall. So basically, because the term loan is the most senior debt, we paid that down first. So you can see that this numbers 603 all the way to 884, they exactly equal 603. And this formula is just to account for like various anomalies that happen. So for example, if the term loan is less than the amount of cash you want to pay for, then obviously you're not going to pay your entire cash flow to the term loan. You're going to pay down a term loan and then use the remaining cash balance onto a subordinated debt. So you can see that this number is 603 and you keep paying it down. And then you eventually, so this is not very illustrative because we're using our money to pay down the term loan because it's the most senior, and typically you'll see this in the first 5 years. But let's say this number is just like 500. You can see that we spent 577. We spent 500 paying on this. That left us with $577 left. So therefore, we're going to pay $577 to our subordinated debt and have this amount go down. So again, this is like complicated Excel work. Just know that you paid this down first, and your remaining cash goes here, and then you have excess cash here that you can invest back in the business. So going back, so therefore, after we paid down a sufficient amount of debt, that means our equity has increased. So you can see here that this is the implied values of the company at each year beyond you entering the company. So you can see here, after we paid $4,952 in equity value to enter the LBO, we have $5,873 in equity value after the first year, $7,122 in equity value after the second year, and then $10,861 after 5 years. And then you get an internal rate of return of these amounts from your implied equity values. And basically, you clearly generate more return as you go on, more projection years. But remember, like, there's a discount rate to your money in the sense that money today is worth more than money tomorrow. So therefore, you can see that the IRR is roughly around the same, even though you can see that there's a higher multiple on the 4952 as you go along. And this is an IRR formula. And the IRR, the official definition of the IRR is the discount rate that makes the present value of your cash flow 0. So essentially, like 4952, and then minus 10861 discounted back to then, that number is 17.0%. If we discount 10861 by 17% every year, we should get 4952 a present value exactly. So that equals 0, and therefore the internal rate of return is 17%. Does that make sense to people? All right, cool. So this is just another sensitivity analysis. That is how LBO works. Again, this is a more complicated model than the DCF. And so focus on getting your DCFs down throughout like the next semester or so. And then you can work on the LBO and try to understand that. Just because, again, that has a lot more jargon than even the DCF and requires a lot more like advanced financial concepts than just like basic cash flows. All right, cool. That's it for today and the semester. It was great working with you all. I am now retiring from CFC VP of Ed. And the lectures are next week. I highly encourage all of you to run because we've had like freshman, spring, and sophomore fall people every year. So Barwin was the last one. He got on e-board freshman spring. and then the year prior it was like someone else. I forgot. And then our old president Ravi was also on e-board freshman steering, so we typically like people, younger members, to run so they get experience as well as stay involved and contribute to the club. Who knows? I think it's the Han, but we'll see.
Yeah, he told me he wants to do it.
Yep. I mean, the Han's a very talented kid. I'm sure he'll do a good job. Oh yeah, so there's a line on top. So you can either do public or private. Because it's like you buying a company, paying down the debt with its cash flows. So it can either be private or public.
Okay.
So like with private,
Like a common stockholder for a public
hmm?
company. It's about just get it 25%.
Right. So typically what happens is there's like